Good morning. Good morning, ladies and gentlemen. I'm excited to be here this morning and welcome to our quarterly investor briefing. So the agenda basically I'll make a couple of remarks, then I'll turn it over to our esteemed CFO, Mr. Malcolm Sadler, who will just go through with you the quarterly results. Then the microphone will flip back to me and I'll make some brief statements pertaining to why I'm excited and happy today. Then we'll turn it over to Mr. Almeida, and thereafter we'll have question and answers. Before I turn it over to Mr. Sadler, I just want to emphasize where we're coming from over the last 3 weeks. 3 weeks ago, there was a milestone, what is now a milestone article. At the time, I didn't know it would have been a milestone article. It was entitled, "I'm Not Happy." Today, I'm here to say to you, I'm very happy. I'm going to tell you why. You see, this institution is an outstanding platform with the best track record of nation building and creating stakeholder value. It aligns personally, it aligns with my own personal mantra, which is summarized in the Latin expression, prosperitas cum caritate, which means prosperity with care. Prosperity with care. Doing well by doing good. That's how I've always lived my life. And so when you have an alignment between your own values and the company's values, it's magical. So why am I happy? I'm happy because this is a great platform, a foundation, and it is comprised of over 2,500 wonderful people who dedicate themselves every day to building a better future for not only themselves, but their families, their community, their country, and the world. But like most companies, like most people, sometimes we drift. So I'm happy to say that today, I have my hands, as the executive chairman, I have my hands firmly on the wheel. So, therefore, what it means is the buck stops here. I'm 100% responsible as the executive chairman for the direction, the fate, and the outcomes of this organization. That's why I'm happy, because I'm responsible now. Today, we're going to deal with some of the vexing issues that has plagued us for the last many months, which is no dividends. We're going to give you a clear path to dividends with timelines. So with that, I turn it over to our Chief Financial Officer, Mr. Malcolm Sadler.
Yeah. Thank you, Chair. Ladies and gentlemen, Chairman, Honorable Michael Leachin, OJ, Interim CEO Robert Almeida, Corporate Secretary Dave Garcia. Good morning. I'm Malcolm Sadler, Interim Group CFO, and I'll be presenting our most recent financial results released recently. The group reported consolidated net profit of $13.7 billion for the 9 months to June, a $12.2 billion or 47% reduction from the prior year. Despite the decline in net earnings in the current period, there has been consistent quarterly improvements in the net results as we navigate the constantly shifting operating environment while executing a range of strategic initiatives. We continue to focus on improving our financial performance quarter over quarter via operational efficiency and overall customer experience, and the group has been investing in world-class digital and analytics capabilities. As was stated in the previous quarter, the accounting standard IFRS 17 insurance contracts will be implemented by the group effective October 1, 2023. Our insurance subsidiary GHL has already adopted IFRS 17 effective January 1, 2023. However, the group's consolidated results for the 9 months ended June 2023 were prepared based on IFRS 4. The implementation of IFRS 17 is expected to impact the financial statements in terms of presentation, recognition, and measurement of insurance contracts, mainly in the life, health, and pension segment. We'll provide detailed comparisons on the effect of the implementation at the end of the current financial year. We have been proactively managing the implementation and expect a seamless transition at the group level. Our operating entities continue to maintain strong capital and liquidity positions. However, we are still vigilant in our capital management practices to guarantee business expansion and continuity while balancing returns to shareholders. To this end, the Board of Directors thought it prudent not to pay an interim dividend at this time. I can assure you that we are aware of the concerns of our valued shareholders and are actively working to ensure the resumption of dividend payments at the earliest and most appropriate time. Conserving capital has been a focus for the organization to ensure resilience, and we're implementing measures to realign our commitment to fulfilling the needs of all our stakeholders. I will now review the main points of our financial performance from the results released recently. As earlier mentioned, the group reported net profit of 13.7 billion. Profit attributable to our shareholders for the 9-month period was 9.7 billion, representing a 48% or 8.9 billion reduction compared to the prior year. Operating revenues declined to 96.8 billion, reflecting a reduction of 8% or 8.8 billion. Lower net revenues from insurance activities has resulted in an overall reduction in operating income in the current financial year. I'll expound on the insurance segment's performance shortly. The net revenues from banking and investment activities increased by 6% or 4.7 billion, as improved gains on foreign currency and investment activities, along with higher net interest income and net fee and commission income, which offset higher credit impairment losses. Operating expenses of 78.9 billion increased by 1.7 billion or 2%, primarily as a result of staff costs growing by 2.8 billion or 7% over the prior year, due mainly to negotiated increases and other staff expenses. The group is actively pursuing various cost optimization strategies, and it will take time to get to the target cost-to-income ratio. However, we are dedicated to achieving the goal. Given the reduction in operating income coupled with the increased operating expenses, our cost-to-income ratio increased from 71.87% in the prior year to 77.6% in the current year to date. The lower profitability for the current year to date has resulted in reductions in some of our key metrics, namely return on assets and return on equity. Return on assets, 0.85% up to June. Return on equity, 7.76% up to June. Prior year, return on assets would have been 1.75%, and return on equity, 16.14%. We finished the third quarter with a positive trend in performance, reporting an improvement in net profit of 7.4 billion, 2.4 billion or 48% above prior year March quarter, or above prior quarter March 2023, that is. The group reported net operating income of 35.6 billion for the June quarter, increasing by 4 billion or 13% over the previous quarter. This improvement was led by banking and investment activities. There was some rebound in stock prices, which led to fair value gains from equity investments held by our wealth segment. We have also proactively evaluated the high interest rate environment and implemented necessary measures to maintain net interest margins. During the current quarter, net insurance revenues declined by 813 million or 16% compared to quarter March 2023. Despite some recovery in demand for new policies contributing to higher gross premiums written by both life, health and pensions, and property and casualty segments, this was primarily offset by higher net claims. We kept our enhanced emphasis on efficiency and cost management in the quarter as we continue our detailed review of expenses across the business. while the operating expenses increased to 27.5 billion for June 2023, recording an increase of 10%, we have identified areas to materially reduce our expenses. Some of our key performance ratios for the quarter improve as a result of the higher revenues. Return on assets and return on equity, and we're looking at June 2023 compared to March 2023. June quarter, 1.36 compared to the prior quarter, 0.94. Return on equity, 12.28 compared to the most recent quarter prior to this one, 7.79%. The cost-to-income ratio also decreased to 74.09% for the quarter, down from 76.12% in the March quarter. We're cognizant of the adverse impact a higher cost structure can have on a business and have taken steps and will continue working to ensure a reduction in the cost-to-income ratio to deliver increased value for all our stakeholders. I'll briefly discuss the performance of our business segments. Our Life, Health and Pension segment generated an operating profit of 11.2 billion, which was a 9.2 billion reduction compared to last year. The segment was impacted by increased claim expenses and negative one-off actual adjustment, combined with additional reserve movements from the annual assumptions update in the first quarter of this financial year. Despite the decline in operating results for this segment, it was the highest contributor to the operating profits of the group. The Treasury segment continues to be the highest contributor within the banking and investment subsegment and reported an operating profit of 7.1 billion, a 16% reduction compared to the prior year. The decline was primarily caused by lower net interest income consequent to rising market rates, resulting in repriced funding outpacing the rise in income. The General Insurance segment recorded operating profit of 6.7 billion, reflecting an 85% increase when compared to the prior year. This segment's net results were supported by increased revenues, particularly gains from foreign exchange and investment activities, and net insurance revenues coupled with reduced operating expenses. The Wealth segment generated operating profit of 6.4 billion, a 4% or 254 million decline compared to the prior year, while the segment reported a reduction in net interest income resulting from interest rate increases, which continue to impact costs of funds. Gain on investment activity started to rebound, increasing by 1.7 billion over the prior year. The market conditions have impacted trading opportunities in the market. Despite the slowdown in investing prospects, we're positioning the portfolio to capitalize on opportunities going forward. The Corporate and Commercial Banking segment continues to show steady improvement, reporting operating profits of 5.1 billion, up 176 million or 4% over prior year. The segment benefited from increased net interest income as a result of actions taken over the preceding months to preserve net interest margin, which was a key driver of growth. The Payment segment generated a net result of 871 million, which was 1.4 billion below the prior year. This segment includes our card acquiring, card issuing businesses, as well as the operations for our mobile wallet Link. The group has made significant investments in Link and has incurred upfront costs to enhance and market the digital payment platform. This has impacted the cost structure during the current period of the Payment Services segment and overall performance for the current year to date. We continue to see growth in our card services business, given increased card receivables, sales, and transaction volumes. This segment remains steadfast in its effort to balance the risk by actively pursuing alternate revenue streams, particularly through cross-border transactions and greater segment penetration. The Consumer and SME Banking segment recorded an operating loss of 363 million, a 1.3 billion reduction compared to the 976 million profit booked in the prior year. The decline stems mainly from the non-recurrence of one-off gains recorded in the prior year due to the execution of branch optimization, the branch optimization strategy in Jamaica, which resulted in the sale of real estate. This segment has been transforming in order to increase profitability, efficiency, and margins. We'll now briefly discuss the components of the statement of financial position. Our asset base stands at 2.2 trillion, an increase of 206 billion or 10% over the prior year. The group continues to experience growth in our main earning portfolios, driven primarily by increases in loans and investment securities, which grew by 8% and 6% respectively. In terms of our shareholders' equity increased to 183.9 billion, up by 25% or 37 billion over the prior year, and this is shareholders' equity attributable to our shareholders. This was primarily due to reduced unrealized fair value losses and increased retained earnings. Customer deposits grew to 739.1 billion, increasing by 4% or 27 billion over the prior year. Obligations on the securitization arrangements was 98.5 billion, reflecting a 42 billion or 75% increase over the prior year. This was due to the successful raise of US $300 million at the end of the prior year. Policyholders' liabilities increased to 465.3 billion, up from 443.9 billion in the prior year. In terms of capital, all our regulated entities exceeded the applicable capital and also liquidity regulator requirements. Ladies and gentlemen, esteemed stakeholders, we want to reassure you that we remain resolute in our commitment to strength and stability. As we move forward, we will keep developing and implementing initiatives to strengthen and sustain the existing solid framework with a keen focus on continuous improvement. We maintain that we are well positioned to capitalize on opportunities to expand the business and boost operational efficiency for improved performance, and we're confident in our team's ability to deliver. We're focused on our strategy to reinforce the resilience of the group as we make investments for growth while prioritizing capital management and our costs to create capacity to deliver on sustainable long-term value. As I close, I want to acknowledge our exceptional team, whose unwavering dedication and perseverance is the fuel that drives our progress and achievements. I would also like to extend our heartfelt thanks to our valued customers for their unwavering loyalty and support. Your trust in our services is what drives us to continually strive to improve our service quality and experience. We're excited about the opportunity to continue to serve you for years to come, building on the relationships that we have cultivated over the years. I will now turn over the proceedings back to the chairman.
Thank you very much, Mr. Malcolm Sadler. As I said, I'm going to take a few minutes to deal with an issue that is relevant to all stakeholders, actually. And it's the vexing issue of why no dividends. I'm going to make sure that you'll have a clear path to dividends with timelines, as I mentioned earlier. You see, a financial institution has to ensure that has to ensure a few things. Number one, long-term continuity, strength and confidence in the institution itself. It has to strike the balance between many stakeholders, which would include depositors, customers, regulators, shareholders, staff, government, and its brand. The prime responsibility of governance is to ensure that all stakeholders are fulfilled. Governance doesn't end with the board or board committees. In fact, it encompasses every single staff member, taking responsibility for the aforementioned stakeholders. It's not just the board of directors' responsibility, it's the responsibility of every single staff member to take responsibility and ownership of depositors, customers, regulators, shareholders, staff, government, and the brand. You see, the metaphor I like to think of is, if every citizen in the world lived by a simple rule, the golden rule, in other words, took governance over their own behavior, live by the golden rule, which is, do unto others as you'd have done unto yourself, then there will be no need for the police. There will be no wars. Likewise, governance starts with the individual. You see, when Mr. Buffett was asked, how did you actually become so wealthy, so successful at investing? He said, the first rule of investing is don't lose your principal. The second rule of investing is don't forget rule number 1. You see, risk management is therefore at the heart of the long-term success of any and every organization. Risk management. Risk management does not mean quit taking risk. It means managing decisions to ensure the long-term continuity, strength, and confidence of the organization, of the consumers, the country, to the organization. You see, when you're, there's another mantra that I have that I like to share with you. You see, success, and it's just a natural human frailty. Success begets complacency, begets bad results, right? It's common in all around us. When you become successful, the natural tendency is you hang back, you sit back, you become complacent. And you become complacent, you have just changed the rule, so one has to be careful. So when you're in a comfortable position, we have to make sure we're not setting the stage for decay, right? So the other constant for a business is change. A business must adapt to change, try new products, processes and services, respond to changing technologies, economics, and customer needs. Governance is about managing these changes. Governance is about managing the necessity to be open-minded, the necessity to take chances, and the imperative to not just go along with the crowd, and at the same time be very prudent. Companies and investors that refuse to change when it is clearly evident a strategy or process isn't working is bound for mediocrity. You see, there are things that we control in life and things that we don't control. Those things that we don't control, we should be very mindful of them. And when they present themselves, we should have a plan to deal with them. But those things that we control, we should do them perfectly. So I just want to bifurcate that also. So we are not about to hide behind things that we don't control as excuses for our shortcomings. We're not about to do that. Governance is about building trust. You see, trust is the essential foundation of any business. Consumers must trust the products, that they will do what they promise. Investors must trust that management is competent. Employees must trust that management will live up to its obligations. Governance is also about being strategic. Being strategic means that one has to take time to think. You see, there are many examples of management not thinking about the consequences of their behavior, which could have averted mediocrity. You see, some examples would be, actually, there are human biases. Being human, there are natural biases that we have. Managers suffer the same biases. There are emotional biases, confirmation biases, greed and fear, and groupthink. Actually, Henry Ford once said, thinking is the hardest job in the world, which is probably why so few people engage in it. So I wanted to deal with governance because our path to dividends, we have summarized here in terms of 3 simple letters. E, G, C. E means we have to be a lot more efficient. G, we have to make sure that governance is understood right throughout the organization. C, we have to make sure that our customer experience is the best in the world. We're not standing for any more mediocrity customer experience. We want to make sure that our customer experience can be of the highest standard in the world. So let's talk about customer experience. You see, CEOs who isolate themselves from their business or who surround themselves with yes people are likely to be mediocre. Managers that do well understand their marketplace, customers, staff, and competitors. The best managers are very conscious that bureaucracies will occur naturally because committees are normalized in business. The committee approach to managing business have some known limitations and danger. They have some strengths, yes, but they have some known limitations also and dangers. Biggest one is groupthink. To combat bureaucracy, we must have a disciplined approach to decision making. Every expense we make, every department we create, every project we take on has to answer the basic question: will it create and serve customers better? If the answer is no, the contemplated spend will be eliminated. Once you decide that you have projects that are unrelated to customers, you will have bureaucracies composed of individuals doing things extremely well that they shouldn't have been doing in the first place because it didn't serve the customers. You see, the best managers don't send mixed messages. Our message has to be crisp, clear, and focused. Sending mixed messages or confused signals to staff or customers will jeopardize our competitive position, resulting in mediocrity. We therefore have to ensure that our message actions are advocated by our staff who have the right incentives, values, and purpose. So that will be our total approach towards customer improvements. Let's talk about efficiency improvements. Well, experts and consultants have vested interests, biases, and shortcomings. The best consultants are our staff, who sees these inefficiencies every day, and they have pragmatic solutions to eliminate those inefficiencies. So, we are going to make sure that we enable our staff to really float up to us, geyser up to us in management. What they see as inefficiencies that we can address 100%. So ladies and gentlemen, that's a qualitative strategy that we have to getting back to dividends. And when we implement those 3 letters, E, efficiency, improvements, G, strengthened governance, and C, customer experience, there's no question as to what will happen. Dividends will flow. And I'll say to you, as of the last 3 weeks, since interim CEO, Mr. Almeida, and myself, we have been installed in this position, there has been decisive actions taken, which I'm going to turn it over to Mr. Almeida, in terms of cost annual cost reductions, and the number is encouraging towards making sure that dividends will resume very soon. And I'll say this to you, our aspiration, because it is it aligns with all the stakeholders, is to get dividends flowing ASAP. Thank you very much. I'll turn it over now to Interim CEO Robert Almeida.
Great. Thanks, Michael. Thanks, Malcolm. Let me start here. So, good morning and welcome to the Board of Directors, my colleagues, shareholders tuning in from across the region, media, customers, and ladies and gentlemen. Thank you for joining us for this fiscal year 2023 Q3 investor briefing. So it's my pleasure today to address you as the Interim Group CEO. I've actually been involved with NCB, with the NCB Financial Group for over 20 years now. So I was part of the AIC team that came down right after AIC acquired NCB back in 2002. Did a number of different things that I was involved in, and then later in the capacity of director, and now have the privilege of serving as Interim Group CEO. I'm going to start off just by telling you a little bit about, kind of, I guess, looking backwards, and then we'll switch to looking forwards. So throughout my tenure with the NCB Financial Group, in various capacities, a few things have remained unchanged. Firstly, the NCB franchise. This is the core businesses. So remember that NCB Financial Group is a holding company that has a number of core businesses, operating businesses that interact with customers. They do real things, provide real solutions to real customers. That we call the fundamentals. Those operating subsidiaries are our strength. So NCBJ, Guardian Insurance, Clarion Bank, they're all led by experienced teams with very strong records, extremely competent teams, and staff and operations that go out every day and serve the customers. So with those strong pillars, the future of NCB Financial Group remains bright. Now you hear, everyone says this, so uncertain global conditions, I always feel like this is a very repetitive thing. You can watch it on any news channel, Bloomberg, CNBC, take your pick. You'll hear everybody talking about uncertain global economic conditions. I don't actually know a time when there weren't uncertain economic global conditions. So there are uncertain global economic conditions, that's a reality. But our operating subsidiaries, what we control, what Mr. Lee Chin said, the things outside our control and the things within our control. So our operating subsidiaries have remained profitable. They've remained liquid. They've remained well capitalized, and they maintain strong market share in key areas of real businesses, real things that serve real customer needs and provide real customer solutions. So loans, deposits, credit cards, capital market transactions, insurance, general insurance, life insurance, health insurance. Among the companies listed on the Jamaican and Trinidadian stock exchanges, NCB Financial Group and Guardian continue to be among the most profitable and well-capitalized groups. NCB Financial Group, including its operating subs, operate in a highly regulated industry. And I stress this because this should give people confidence. It is a highly regulated industry with very competent regulators. And each entity consistently meets or exceeds the regulatory requirements of those regulators. NCB Financial Group and Guardian Group are both publicly traded on both the Trinidadian and the Jamaican stock exchanges. And they consistently publicly report financial results in accordance with the rules of the respective stock exchanges and accounting standards. And I thank Malcolm for going through I'm an accountant, but boy, going through the actual financial disclosure commentary is always such a difficult job, and I really thank Malcolm for doing such a good job walking through it. The strength of our main operating subsidiaries has been further confirmed by independent parties. So we've got the Bank of Jamaica, but we've got ratings agencies, Fitch Ratings. Under Kerry Chris, we're Kerry AA-. Under AM Best for the Trinidad and Tobago insurance entities, we're A- excellent. And we've also received awards such as Global Finance Magazine's Safest Bank Award in 2022. Our customer deposits, investments, and insurance policies are secure. Secondly, NCB Financial Group continues to demonstrate the ability to pivot, make changes, rise again, faced with challenges. During the unprecedented challenges of the pandemic, Guardian Life innovated by introducing e-pharmacy services, thereby bridging the gap between patients, doctors, and a virtual pharmacy. Leveraging the One Guardian digital platform, Guardian's customers in Trinidad and Jamaica now enjoy omni-channel experience, offering quick quotes, online payments, and a comprehensive view of their portfolio across insurance and investment products. We're basically trying to make customers' lives easier, make it easier for them to avail the services that help make them conduct daily life from a financial perspective. This platform additionally provides a health e-card and an artificial intelligence, the new thing, artificial intelligence bot for real-time customer support. NCBJ has also shown resilience and strategic acuity in the face of numerous challenging periods, including the 2008 to 2009 global banking crisis, the Jamaica debt exchange, the national debt exchange, all of which resulted in billions of dollars in lost revenues, and then more recently, we had to navigate through a global pandemic. Longevity and persistence of our institutions bear testimony to the resilience of the group. Guardian's history goes back to 1847, NCBJ traces its roots back to 1837, and Clarion is the new kid on the block, having been operational since 1975. In conclusion on that point, while our institutions may evolve in response to changing times, the franchise remains steadfast and enduring. Third, NCB Financial Group, by way again, I talk about these operating entities. They're the pillars of the individual of the group. They also remain pillars in their communities and the communities they serve across the region. Our commitment is unquestionable, and I'll run through a few, and I won't run through them all, but we'll run through a few of the things that we do that create impact within the local communities. From its inception, the Clarion Foundation, which is a charitable trust responsible for overseeing and executing all of Clarion Bank's philanthropic endeavors and donations, has been committed to providing financial and in-kind support for charities and their fundraising efforts. This mission is aimed at improving the lives of Bermudians and ultimately strengthening our wider Caribbean community. Today, the Guardian Group stands as the largest insurance services brand in the English and Dutch Caribbean. This insurance is something that everybody relies on. It's protection. And so the very core business is impactful and helps people in the region. Its purpose to provide peace of mind and prosperity to communities in the Caribbean and across the world has allowed Guardian Group to earn a well-established reputation for being there for its customers when they need it most. Through its corporate social responsibility initiatives, including Happytalism, a regional initiative centered on the key issues of mental health and financial well-being, which are just global issues these days, and Shine, meaning securing hope for those in need, Guardian has forged a strong reputation across the Caribbean. Other initiatives include the Shoebox Project, the partnership with Eden Lodge Youth Charitable Trust to offer lunch grants to secondary school students, and its partnership with the Rotary Club and Rotaract Clubs of Barbados South to launch the Owen Arthur's Agro Kids initiative for primary schools, aimed at combating childhood obesity in Barbados. In Trinidad, NCB Merchant Bank is actively empowering local SMEs by providing them with crucial loan and equity financing. This action stimulates economic growth and job creation in Trinidad and Tobago, playing an indispensable role in shaping a brighter future for all. In Jamaica, for decades, NCB has pioneered financial access, introducing Jamaicans to a range of financial services such as credit cards, traditional and intelligent ABMs, point-of-sale machines, digital loans, and most recently, NCB Pay. In 2019, we introduced Go IPO, a groundbreaking platform that dismantled barriers restricting investment opportunities to only the affluent and wealthy. Through NCB Capital Markets Limited alone, we have opened the doors of financial growth for over 40,000 new investors and counting. Amid the chaos of the pandemic, we took decisive action, leading the charge by implementing loan moratoriums that provided much-needed relief to our customers. These moratoriums extended to over 18,000 customers and covered over $40 billion in loans, stood as a testament to our commitment to stand beside those facing hardships. Our e-commerce platform was pivotal in helping most SMEs transition their operations online and stay afloat. Through the NCB Foundation, we have made over 2 billion Jamaican dollars in donations since 2002, impacting over 200,000 lives, predominantly through educational support. Throughout our journey, NCB has remained a consistent contributor to the Jamaican economy. Since 2012, we have dutifully paid over 15 billion in asset taxes to the government of Jamaica. It is indeed fair, I think, to say that our commitment to and our impact on the region is significant. I said I'd talk a little bit about the past, maybe a few more minutes than you were hoping for, and then turn to the future. So as I look back in the past, like I said, I've had many different capacities along the way. There are numerous accomplishments that are a source of pride. Nevertheless, we also recognize that we have a host of opportunities for improvement that have captured our steadfast attention. As Mr. Leachin kind of referenced, we have allowed excess costs and efficiencies to enter into our business. These costs and inefficiencies have distracted from our customer focus, adversely impacted our cost-to-income ratio, and prevented us from paying dividends to our trusting shareholders. In line with Albert Einstein's famous words, and I'm not one to quote a lot, but I'll quote this one, the measure of intelligence is the ability to change, and we must change. The chairman identified 3 key areas of focus that align with our group's purpose: empowering people, unlocking dreams, and building communities. Those 3 areas, EGC, as the chairman mentioned, efficiency, governance, and customer experience. And they will constitute a central part of the future direction of us as an institution. And I'm going to try and make that a little bit more real for you and a little bit more tangible so it doesn't just stay abstract and conceptual. And it brings us back to the pathway to dividends. So I'm actually going to talk to you, I'm going to come to efficiency in a moment, but I'm going to start with governance. So when I think of governance, there's 2 key things that I would like to leave you with. First of all, what Mr. Leachin was talking about, it's about personal responsibility. It's the control, it's the governance of our own behaviors. And then the second thing is, to what end? And he said the golden rule. So do to others as they would have them do unto you. And secondly, don't do to others as you would not have them do unto you. So from a governance perspective, it's about behaviors. Take responsibility for our own behaviors, control them, focus on what we control individually. Then when we think about efficiency, to ensure it's really imperative that we get our cost-to-income ratio down. So today you heard us talking about cost-to-income ratios in the 70+% range. These are not world-class standards, and we have to confront that reality with honesty and a determination to enhance that efficiency. To put the percentages into context, because very often it's difficult to figure out what percentages mean. So to put this into context, I want you to think about each 1% of that cost-to-income ratio represents about $1.5 billion. And if we reduce that cost-to-income ratio from the low 70s to the 60s to get to about 60%, that would be like 10 percentage points. And that 10 percentage points in cost-to-income ratio, going from around 70-ish% to around 60-ish%, would be worth about $15 billion, which is about $6 per share of NCB. Now, when you think, why is that so important? Because that gives us options so that we don't have to do trade-offs then. We actually can do both. We can continue to strengthen our capital so that we can withstand any kind of storm, which is what we have been doing, but we can also make sure that we're paying dividends. And so the focus is on efficiency, the focus is on cost reduction. Now, I started with governance because it said it has to start with personal responsibility. So it starts with us. What are the things that we control? And Mr. Leachin started to refer saying, hey, we already actioned certain things. So it starts with saying, you know what are the things that we control that are the easiest for us to get our hands wrapped around? And we've identified in the last 2.5 weeks, I'll correct Mr. Leachin, it's not yet 3. So in the last 2, so we've identified and actioned annual recurring cost reductions that would be in the $6 to $8 billion range, and they are actioned. So $6 to $8 billion, and they have been actioned, and we're on our way to fully implementing them. those are the things that are easiest to control from my seat. And so starts there. Then we actually, remember I was talking about $15 billion of efficiency improvements. So that's the 6 to 8. So let's say we get about halfway there with the things that we've already put in motion. The next half is, it was earlier mentioned by Malcolm that we've done a lot of investments in transformation activities. We've done a lot of investments in technology, and it's now time for us to harvest those. So those actually come into the efficiencies at the branch level, at the call center level, at the BPO level, in finance, all across the business, in insurance, at the agent level. Those are the ones that permeate through the organization. So we would look to get more efficiency improvements out of the rest of the operations as well. That combination, we'd look for it to, in this very early phase, to take us into the 60s, into the low 60s in cost-income ratio. And as I mentioned, when you do the math on that, getting to about 60% would mean about $15 billion more on the bottom line. So that's the primary focus. It's EGC. So when we take personal responsibility, what are we then going to ask everyone to do in the organization? It's about taking personal responsibility for being efficient. And what does efficiency mean? It says, look around. If you see waste, try and figure out how to get rid of it. Let's jump up and down on the table and get rid of waste. And what is waste? Anything that doesn't add value to the customer. Anything that doesn't add value to the customer is waste. So if we just get very simple, we focus on that, and we've already started with the things that are easier for us to get our hands wrapped around, being decisive. We're about, we'd like to say we're about halfway there. And we've only just begun. And that would take us towards getting cost reductions in. It would free up more distributable free cash flow in the business. The distributable free cash flow would allow us to continue there'll be a lot of questions on Basel III and things like that. We're well on our way. We've always focused on capital strength. We'll keep doing that. But extra $15 billion gives us lots of room to return back to paying dividends. And so that's our pathway. That's the strategy we're on. And I've probably used up as much time as I want to hear because we want to take your questions. So thank you very much. And I think, Chairman, we're on to questions.
Thank you very much, Mr. Interim CEO. We'll now open the forum, the microphones up to questions. Make sure you pass the hard ones off to Dave Garcia, okay?
Chairman, thank you. We have a number of questions already in. In fact, I don't think we're going to be able to take all of them. We'll take as many as we can, and I think we're also going to have to, in fairness, allow a little bit more time after the 11 o'clock, because we only have 12 minutes, and that's maybe 2 or 3 questions. All right, so I will pass the first hard one, though, over to Malcolm Sadler. We have a question coming from David Rose. Now, there have been a few questions on dividends, but I think that most of them have been answered in the addresses because all 3 of our panelists have spoken to that issue. But this specific one comes from David Rose. Malcolm, he asked, with respect to dividends, is Basel III and the reduced earnings at NCB Capital Markets level a reason why capital cannot be upstreamed to NCB Financial Group for the company that ultimately pays dividends? And also, have the increases in interest rates affected the potential for dividends given that NCBFG has to pay higher financing costs?
Well, thanks, Dave. Well, to start with the rise in interest rates, that has impacted all the entities across the group, including the holding company in servicing its debt. So we have seen rising interest costs right across the board, impacting all entities. We have indicated at prior investor briefings that we are positioning ourselves to get ready for the Basel III implementation, and therefore we are ensuring that we conserve capital to meet those ratios. As you would be aware by now, in terms of what we have said in the past, Basel III will the requirements will be higher. We'll have higher capital standards, restrictive capital definitions, higher risk-weighted assets in terms of under Basel III measurement. Additional capital buffers will be required, higher requirements for minimum capital ratios. And in terms of conserving capital, when we look at the industry assessment by the BOJ, the BOJ expects that capital adequacy ratios may fall up to, let's say, 260 basis points. So that requires conservation of capital to meet those ratios. So in terms of NCB CM, I mean, NCB CM is a group in capital markets right across the Caribbean within Jamaica. And as I said earlier, interest rates would have impacted them. As the interim CEO indicated, all entities will be looking at reducing operating expenses from the perspective of cost-to-income ratio, and that will allow for all entities to be in a position to upstream more to the parent.
Thanks, Malcolm. I had another Basel III question, which I was originally planning to give to Bob, but given how you've handled the previous one, and I think you've partly answered this, I'll give it to you as well. It comes from Marion Ross Amar. What impact does management anticipate Basel III will have on NCBJ's risk-weighted asset calculation and capital adequacy ratios? How is management preparing for this? I think you've partly answered, but specifically in relation to the risk-weighted asset calculation, perhaps.
Well, the risk-weighted assets will increase. There's an additional component under Basel III, which is operational risk. So it's three main components. Currently, we have the credit risk, the market risk, and now we have the operational risk on the Basel III. So that will add to the risk-weighted assets and the need for more capital. We are preparing for Basel III. We have been preparing for a while now. We expect Basel III to be implemented sometime in 2024. And we will be ready for the implementation. We have been having discussions with the BOJ, the industry, in terms of the buffers, because there will be additional buffers on the Basel III. Dave, I'm not sure if I answered all.
I think I'm going to take it as you're having done. So, yeah, Rob?
So the question, obviously Basel III gets complicated, right? So what I hope you take away from what Malcolm said is, first and foremost, this institution has been preparing for Basel III for the last couple of years, and is actually pretty well prepared for Basel III. So that's the first point. So yes, Basel III requires more capital. Yes, Basel III increases ratios, increases risk-weighted assets. But this organization has been preparing it for the last couple of years and been building capital, and you can just see that in the capital that's on the financial statements. The second thing is the focus then goes on, as we described, because it's the impact on the dividends and what does it do to the ability to pay dividends. It's the focus on the cost-income ratio, and if you get the cost-income ratio down, then the Basel III changes, which is, like I said, for the most part, we've been building capital for it. And then we also want to bring the cost down, which will create more distributable cash flow, notwithstanding the fact that we would also be building capital for Basel III.
All right. Thanks, Malcolm, and thanks, Rob. Malcolm, I'm going to come back to you with another question from Marion Rossamar, which is it possible to share with investors any additional information on the existing capital adequacy ratios for National Commercial Bank, Jamaica Limited, and for NCB Capital Markets?
Well, let us look at all regulated entities. They're all compliant. They're all above the minimum regulatory ratios. So there are a number of entities, not just in Jamaica, but right across the Caribbean, that must comply in terms of regulatory ratios. What I can give you, I can give you the ratio for the industry. And when we look at commercial banks, the most recent release, commercial banks averaging 13.7% in terms of capital adequacy ratio. And overall, in terms of all entities regulated by the BOJ, that ratio is at 14.2%. And in those ratios, NCB is a part of those ratios.
In fact, a large part.
A large part, yes.
So, in other words, if persons do the math, the
Yes,
sector
yes.
can't be that healthy without NCB being at a certain level. Thanks, Malcolm. Now, I'm going to come back to you now with some IFRS 17 related questions. I'm going to combine a couple questions, one from Christina Meredith that we received, and one from David Rose. Both are asking about the impact of IFRS 17, given that GHL has implemented it, but NCB continues to report on the basis of IFRS 4. So does NCBFG expect to see a material impact when the group, that's NCBFG, transitions to reporting based on IFRS 17? And can you give any indication as to what the expected impact might be?
Okay, so thanks, Dave, and thanks for the question as well. So we're still in the process of doing the assessment in terms of the impact on NCBFG overall. We will release those numbers in our release for Q4 in terms of our audited accounts for 2023. We will release the details of the impact going on our financial statements going forward on the IFRS 17. You would have seen GHL's financials, and we expect that there will be retrospective impact. It will, prior year numbers will be restated. More or less you'll see a lower profit number when you restate the prior year. And if you look at GHL so far, they have improved. If you look at their Q1 versus Q2 on the IFRS 17, they started off low and they're improving. And if you look at their prior numbers, you would have seen much lower profits in the prior year. So the flow through to NCBFG may not be one-on-one in terms of what you see in GHL's financials. It may not flow through fully in that way. But we will do the assessment and we'll share the details with you at end of year.
And I'm going to add again. So I think if you take a look at, I think David, you asked the question. So if you take a look at the Guardian statements, you'll be able to get some preview of it. And I think what Malcolm referred to is probably a bigger impact on the retroactive comparatives than there is on the current performance. And so you're starting to see in the second quarter, Guardian had a great quarter, and it's getting better. But there was kind of like the restated historical under IFRS 17 goes down. So by the time we start doing ours, you'll have a couple of things happening. One is you've got the basic business improvement that's taking place, and at the same time you've got the dampening effect of IFRS 17 on reported profits. Over time, the IFRS 17 impact goes away because in the long term it doesn't affect it. It's net neutral. So what happens here is we will get we should get a dampened impact of whatever Guardian is seeing, and what you see in the Guardian financial statements is it's the comparable prior year that is more impacted than the current performance.
Thanks, Malcolm. Thanks, Rob. We're gonna throw some questions now to our panelists who are participating virtually. I'm gonna start with Ian Chinapoo. So Ian, I hope that you're hearing. Can I just get a check on that?
Can you hear me?
Excellent. Thank you, Ian.
Sure.
So first, some questions that have come from Joel Anthony Julian. And he's referring to some recent remarks by the Trinidad and Tobago opposition leader who has raised some concerns regarding the financial strength of Guardian Holdings and its subsidiary Guardian Life of the Caribbean. Do you have any concerns regarding any potential run on Guardian Holdings or any of its subsidiaries arising from the statements? Generally, if you could comment on, how you respond to the concerns and how the company plans to address and mitigate any potential impact on its operations and stakeholder confidence.
Thank you very much, Dave, and good morning to all. We have not experienced any concerns in this regard. We really don't. We have been prudent, and we are prudent risk managers. We will continue to engage with all of our stakeholders, including our regulators, confidently and transparently in the normal course of our business activities and full disclosure in our reporting. So really no concerns in that regard.
All right, thanks, Ian. And another one for you quickly while I have you on the mic, so to speak. GHL has continued to see year-on-year improvements. And this question, I should have indicated, is from David Rose. What's your outlook going into the remainder of the year with the reinsurance market remaining tight and with GHL's digital-first strategy continuing to be pursued?
But my outlook is very positive. It remains that way. Our actions and our strategies to manage not only the globally rising reinsurance costs, but also higher inflation rates, which impact the replacement cost on insurance coverages, which means a higher dollar value of coverages needed. So we are confident that we will contain the impact of those rising costs and allow our property and casualty business to grow responsibly and keeping our customers very well protected, notwithstanding the rising costs.
Thanks, Ian. Let's take a question for the other Ian Shuron. Ian, can I just get a check that you are able to hear fine and speak?
Yes, Dave. Good morning to you.
All right, good morning. So this question also from Mr. Rose is, could we get some color as it relates to Clarion's performance in your market and possible opportunities to grow the balance sheet to your previously mentioned targets?
Absolutely. And thank you, Mr. Rose, for your question. Good morning, all. Firstly, let me talk about the financial stability of Clarion, in particular, our capital, liquidity positions, and asset quality. I'm pleased to report a very robust capital position, noting Malcolm's comments with regards to industry standards. In Bermuda, we have no lender of last resort. Our regulatory capital requirements exceed those of other kind of peer jurisdictions. But I'm pleased to report from Clarion's perspective, we have a total capital ratio of 24.69% as at June 30th. Well in excess of minimum regulatory capital requirements, significantly able to support any stress events, as well as to support growth of the balance sheet. From a liquidity perspective, we maintain a very prudent liquidity management position. As a result, our liquidity coverage ratio is 171%, again, well in excess of regulatory requirements. And then lastly, we measure Clarion's asset quality by its NPL ratio as a primary measure. On a year-on-year basis, I'm pleased to report that we've successfully reduced our NPLs by greater than 35%, with a current NPL ratio of 6%. While significantly improved, This continues to remain higher than our risk appetite, and we continue to execute plans to reduce that non-performing loan ratio as a function of both loan growth as well as absolute reduction in non-performing loans. Insofar as growth and performance, again, I'm pleased to report loan growth of approximately 8% in alignment with that of the group. Whilst from a Clarion perspective, it's slightly behind our forecast, I think that is a function of timing more than anything else. We've upheld very conservative underwriting standards, and our pipeline remains strong. As a result of that growth achieved and the current interest rate environment, our net interest income is up by 18%. Other income, which is primarily our wealth management segments, is up by 23%, and total revenue is up by 19% as a result of that. We've managed our expenses prudently, taking into account the chairman and Mr. Almeida's comments with regards to cost to income ratios. And I'm pleased to report a year-on-year net income up by 121%. And I remain optimistic that that trend will continue. Thank you, Dave.
All right. Thanks very much, Ian, for that very comprehensive response. I feel as if you planted David Rose with that question. So I'm going to come back into the room with a question, I think, for Rob. We've had a few questions coming on YouTube from one of our participants there, Natalie Winter. I think most of the questions she's asked have been answered, but one specifically here that I'm seeing is, will the changes result, the changes that have taken place recently, including at the leadership level, result in staff cuts or reassignments within the group?
Yes, that's what, yeah, so obviously that would be a big question for everyone. I started off by saying, so the focus is on efficiency and customers, right? And we start off with the things that are within our control. So the kind of things that when I mentioned the 6 to 8 billion identified and being actioned, you know, they're the things that don't touch the majority of staff. So there. I mean, the short answer to the question is there are no plans for mass cuts, mass layoffs. So just you know, that's the short answer. The longer answer is the business will evolve, the business will change, and so there will be, you know, areas where we add people and areas where people get reduced, and the ask of each person from a personal responsibility perspective is focus on the customer. If you're adding value to the customer, there's no risk, and if you're if you're not adding value to the customer, then look for how you can add value to the customer. Because if we do that, instead, if we add value to customers and we improve our efficiency, drive down our cost to income ratio, there are lots of things that we can cut out in terms of costs that have nothing to do with staff. And so that's probably the biggest message that I would give you in the response is there are lots of expenses that we incur in this organization that have nothing to do with staff. But I shouldn't say nothing to do with staff. They don't have to do with the actual cost to the staff. They have everything to do with staff because staff use those. They're the ones that actually use all of those resources and have a major role to play in telling us where that waste is and where we can cut those other expenditures so that we actually consume less. And as we consume less, our costs go down. And as our cost goes down, we become more efficient, and we're able to serve customers better, give them better pricing, as well as serve our other stakeholders by paying them dividends.
All right. Thanks, Rob. Better experience at a better cost. The question for Septimus Blake, our bank CEO. So, Bob?
Good morning, Dave.
Good morning, sir. First question for you. Well, based on the time, this might end up being the only question for you. From David Rose, is NCB, the bank, set to increase headline interest rates on loan offerings again? And yeah, I think that's it. The other part of his question has been answered.
Thanks, Dave. So I'd say the broad context in which we set rates is heavily influenced by the BOJ policy rate. We do believe that at 7%, they're pretty close to the terminal rate, give or take maybe another 25 basis points. So that's a broad context. We expect that what will happen is that, for assets which are already on the books, that which have a floating rate component, when those come up for repricing, they'll reprice at higher rates. We'd have already done a set of increases in respect of new facilities. So new facilities reflect increased interest rates. And so in terms of going forward, outside of the context that I just mentioned, and if that holds, we don't expect any significant further pass-through in interest rates. That's it. Thank you.
Thank you. And then I think based on the time, this will have to, which will be for Daniel Cameron Duncan. Daniel?
Morning, Dave.
Morning. So this question also from Mr. Rose. I recall the mention that probably a tenth of NCB's ATMs were out of service based on strategic decisions and attacks earlier this year. Where is NCB regarding the size of its ABM network up to now, and how many ABMs are still not able to accept deposits of the new banknotes?
Thanks, Dave. Morning, everybody, and thanks, Mr. Rose, for the question. So today we have 300 ABMs in the fleet that are active and available to customers. Of those, 290 are dispensing the new polymer notes. We have 134 of those machines that are deposit-taking machines. 50% of them today you can deposit the new polymer notes into. We will be upgrading another 45 of those deposit machines by the end of August, bringing us to 108 of 134 machines by the end of August. And then the rest of the machines we expect to complete before the end of the quarter.
Thank you, Daniel. Ladies and gentlemen, we are, of course, over time. Thank you very much for the questions that have come in. As usual, we do not leave any question unanswered. So if your question was not answered during this session, rest assured that our investor relations team will reach out with answers to the questions that you have presented. Thanks for your participation, and I will hand back over to the chairman to close out our session.
Thank you very much, Dave. So what do I want for you to remember from this investor forum? I want for you to remember that we are absolutely resolute in focusing on our stakeholders, all stakeholders, balancing them. And we're going to do that through the three letters I mentioned. E, efficiency improvement; G, governance; and C, the customer experience. The other thing I want for you to leave with you is that in the last 2.5 weeks, as interim CEO Almeida said, and he's a very conservative person, we have identified and enacted on cost savings in the vicinity of $6 to $8 billion annual savings. And the third thing I want to leave you with is we're working assiduously. And Dave may shoot me after saying this, but I'm going to say it anyway. We're working assiduously to make sure dividends resume by the end of this year. Thank you.
No matter who you are, where you are, or what you do, Link are for everybody. Whether you find yourself in a little situation on the hustle, or you're not in the hustle for leave home, we're here to help. Keeping you topped up, putting the solution in your hands, and giving you the joy of choice and convenience, especially when it comes to getting back what's owed. That's why life is better with Link.
Link a change the remittance game. Get money from abroad in a blink with Link. Collect your MoneyGram transfer straight to your phone. Anywhere you're there, 24/7. No crowds, no lines, no hustle. We're talking about that new clothes for the youths, them money. The start up a business money. Buy extra groceries for the month money. They take care of mama medication, so she not have to worry money. And MoneyGram give the best rate to make your money stretch. Download the Link app today. Life is better with Link. Conditions apply.
Today's woman is not just an entrepreneur, a mother, or the girlfriend that gets all the girls together. She's all that and much more. We call her a queen. She's driven to live life to the max, and nothing